Yeah, it's been a very interesting environment for markets the last 18 months or so, and we've seen some pretty dramatic changes in terms of how the markets are behaving and what's being rewarded. We've shifted from an environment starting in early 22, really in January, when Jay Powell and the Fed made it very clear that we were in the early innings of a rate hike cycle. That catalyzed, quite a violent rotation out of a lot of quality growth businesses and really duration assets in general, to include bonds, into energy. And there really wasn't a lot of other places to hide. And you saw really for the first half of 2022, first 3 quarters of 2022, a very big disconnect between fundamental business performance and how stocks were trading. And I think what we've been really encouraged by, so far here in 2023, is you've started to see that change a little bit, and you're seeing companies actually rewarded for delivering good earnings, good cash flow generation, positive outlooks, whereas that really wasn't the case last year. I think an interesting anecdote for our portfolio, the Quality Global Growth, is in 2022, we had about 20% earnings growth on average for the portfolio. Yet the returns were, quite negative, as we all know from the numbers. And so that really, all that underperformance came from just massive compressing of earnings multiples, which certainly some of that is justified in a world where the discount rate is higher. But what we've seen this year is that those companies that have continued to beat and exceed earnings expectations rather than trading down, we're actually seeing those stocks trade up pretty significantly. And there's a whole host of sectors that's playing out. So I would say it's an environment to categorize very generally, where fundamentals seem to be driving it a bit more. Market seems to be a little bit less concerned about rates and inflation, although they're still very much on the radar of markets. There's a bit less myopic focus on just that topic. So we've been fortunate that 2023 is off to a much stronger start in terms of the performance for the portfolio. And, it's really, there's no quick fixes for us. I think that those of you who know us know that we're very much long-term investors. We're always analyzing opportunities from the lens of, is this a business we want to own for the next 5 years or more? And one of the things we were quite active with in 2022 is we had not only our portfolio under pressure, not only our watch list under pressure, really the whole universe that we play in. And so we took a combination of actions last year aimed to improve the go forward return profile of the portfolio over time. That included, number one, leaning into and adding to some of our really high conviction businesses that sold off a lot last year as sentiment was just very negative, especially around higher growth and also really stable quality growth in the sell-off that was driven by rates and inflation and a lot of pessimism. So, using that tool in terms of beefing up position sizes where there's a lot of confidence, and then also adding stocks to the portfolio where we really appreciated the moat trajectory, the culture, the tailwinds, the long-term opportunity for the business to generate tremendous amounts of free cash flow that had been very expensive prior to 2022. And this includes a lot of names in the enterprise tech, enterprise software section of the market, where we really had virtually no exposure entering 2022 because of valuations, and they were so expensive. And you really flipped from, prior to 2022, software was the place to be, to no one wanted to touch it and no one wanted to own it. And there were a number of instances where companies sold off 70 or 80% or more in 6 months, 8 months. And so we really used that opportunity to buy fundamentally wonderful businesses that fit our framework in terms of expanding moats, really supportive, well-aligned, adaptable, winning cultures in their industry, where the market just got too pessimistic. And so while it's hard to call a bottom, those were positions that we've legged into kind of throughout 2022, and even have continued to add to some of those in the early parts of 2023. So, again, these are designed very much for the long term to help the portfolio's returns over longer periods of time. But fortunately, we've seen that some of those moves be rewarded year to date with the snapback we've seen and fundamentals being rewarded again in parts of the market where that just wasn't the case most of last year. When examining our attribution for 2023 year to date, you've really seen contributions to return come from a whole host of areas, both at the sector level and also at the individual stock level. Sector wise, we've had a lot of strength in what were some of the most challenging parts of the market in the portfolio last year. I'll call out semiconductors, where we've seen really strong results from Lam Research and from Integris, which have been leaders in the portfolio. Also, consumer discretionary, where there was a lot of pessimism last year. We've seen really strong performance from businesses like Ferrari, LVMH, and Floor & Decor, just to name a few that have been really strong there. And even our picks within industrials have been quite strong. So it's been fairly broad-based. I could mention a few names in healthcare as well. So we've had really stock selection more so than our sector allocation that have driven results here to date. But I will say our sector over and underweights have been more in our favor than last year. Last year the market was so dominated by energy, which is a sector we have zero exposure to. That led the market in dramatic fashion, and if you didn't own that in 2022, it was very hard to stay relevant in terms of returns. Whereas this year, that has not really been a factor. We've seen both our over and underweights be neutral to slightly helpful, and you've seen stock selection really drive the excess return year to date. When reflecting on the last 18 months or so, there's certainly a few lessons that we've been integrating some changes in terms of our thinking. Of course, our core principles of focusing on companies that are expanding their competitive advantage, that have the right, healthy, aligned, and adaptable cultures, those are non-negotiables. But one of the things we've really had to pay attention to for the first time in decades, frankly, is just the dynamic of inflation. And we're not macro forecasters. We don't know exactly how high inflation is going to stay for how long, but I think it's a very reasonable assumption that we're going to see higher inflation for some period of time than we've witnessed, the last several decades. And so when thinking about the implications for the portfolio, there's really been a focus going back the last 18 to 24 months on making sure, particularly for defensive growth businesses we own, that we have a lot of conviction they can not only maintain growth, but also margins and profitability levels and growth there, if they can preserve that in a higher inflationary environment. And so that really comes down to pricing power, which gets talked about a lot, but not just thinking about it at the surface level, really breaking down for each individual business. What are the what's the elasticity of demand for the good or service they offer? What are customer substitutes or alternatives, or are there none? And ultimately coming to a point where we can underwrite a certain level of pricing power and growth and demand dynamics that give a lot of confidence, and actually seeing higher nominal growth rates, higher profitabilities if inflation persists, but also very strong profitability and growth if it does not. So, you can think about essential services like garbage collection and disposal. We own a best-in-class business called Waste Connections that's vertically integrated. It's focused on smaller markets here in North America, where it tends to have a monopoly. And again, there's going to be no drop off in demand. At least we saw no drop off in demand last year for their services, just because there was concerns about the economy. And in fact, they took up price about 9% and saw a huge lift to growth and profitability. So really, for that more defensive part of the portfolio, making sure we have the companies that are best positioned if inflation does persist for a while here. So I'll start with one that we purchased back in 2022, and that's a technology company called Datadog that's really the global leader in a function called observability, which basically gives a chief technology officer a dashboard to see how every piece of the technology stack of the corporation is performing, from internal IT infrastructure to customer-facing apps, websites, and everything in between. And as you think about one of the dynamics that's happened prior to COVID and certainly accelerated during COVID and is here to stay, is that technology stacks are getting much more complex, much more sophisticated for a variety of reasons that we're all very familiar with. And so one of the challenges is, how do you effectively monitor on all this technology, make sure you're using it not in an optimal way, and also pinpointing when something breaks down, where the breakdown is occurring so that you can fix it as quickly as possible. And so Datadog has built out a really incredible product geared at this market, and they've been able to compound and consolidate their leadership position by adding on more and more features, more and more functionality. And so it's a name that was a fairly recent IPO in the last few years. It was high flying at one point, and early 2022, it just got absolutely crushed with the negative sentiment around growth and software in that part of the market. And so, in our view, the pendulum went from being overvalued to being pretty dramatically undervalued in our view. And so we started by initiating a position in the first half of 2022, knowing how hard it is to call the bottom, but we continued to add to that position throughout the back half of 2022 and so far this year. And we've seen them continue to win market share. They've got a really unique culture within tech. One of the challenges for a lot of tech companies is they don't have a proven business model and they don't make any money. Datadog, since their infancy, when they had a really hard time raising venture capital and early money, by necessity became very scrappy and learned how to turn a profit very early on. And so, and just from culturally, in terms of how they think, how they behave, the ethos, it's a very gritty, scrappy culture that has a proven model that makes a lot of money and is in a part of the market of where the world's going. And you think about these more complex IT stacks. If you listen to earnings calls from any of the Fortune 500 companies, you'll very often hear comments like Jamie Dimon made, for example, at JP Morgan, about how many billions of dollars they're going to increase their IT budget because, you just have to today. And this is a company right at the epicenter of that. They're also, I know AI gets a lot of hype these days. Datadog has OpenAI as a 10-figure client of theirs. So to the extent that we see more activity, I think there's a lot of evidence they're extremely well positioned with what's going on there. And so, that's an example of one that we bought last year. A more recent name that we purchased, just to stay in tech, is Arista Networks. And when you think about kind of the boom that we're seeing in AI, and of course AI exploration and R&D has been going on for a long time, but has really captured the public's imagination more recently. A lot of these AI applications are being done in the cloud, so they're being done on Microsoft Azure, on AWS, and there are some challenges talking to a lot of AI technicians and engineers. Some of the bottlenecks to get even higher output come with some of the infrastructure, and that includes some of the routers and how these various network nodes connect and talk to each other. And so solving for that back-end IT infrastructure is right where Arista Networks plays. And they're, what we'd call an aggressive operator culturally in a pretty lazy industry. They compete against, Cisco and other companies that tend to be, more of a 9 to 5 clock in, clock out culture. This is a hard charging, innovative, highly motivated organization that has been able to really attract superior talent for a long time. And now they're really positioned very well where the world is going to be able to solve for some of these back end IT infrastructure slowdowns vis-a-vis their product offering. So that's one that earlier in 2023, we were very pleased to add to the portfolio.